Thanks so much for that, Chloe. Of course, we will be watching that situation very closely. We are watching the U.S. futures here to see if there's any impact, and we have held steady. If the markets were to open now, the Dow would be higher by 90. Meantime, Tuesday was the worst day of the year for the U.S. markets, partly due to renewed fears about Europe's debt crisis. The Dow and the S&P 500 extending their losing streak to 5 sessions, and the benchmark index dropping below its 50-day moving average for the first time since mid-December. Joining us now is Emily Sanders. She's the chairman and CEO of Sanders Financial Management. And still with us, of course, our guest host, George Goncalves, head of U.S. rate strategy at Nomura. Emily, great to have you with us as well as we're monitoring the events in Indonesia. I do want to switch gears and talk about the U.S. markets a little bit. Over the past couple of days, we've seen a little bit of a correction. My question to you, how much lower could we go?
I'm really not that concerned at the moment, Jackie, and I am encouraged by the rise in the futures this morning. But of course, we were due for a correction. The first quarter was just amazing. I think it overreached on the upside, and we were due for a correction. So I do believe that, we can continue to test the moving averages and go down a bit more from here, but I do see those as good buying opportunities.
Okay. And after sort of the new year, the mantra here in the States was we're not really going to worry about Europe so much. We're going to focus on U.S. fundamentals, which appeared to be strong at that time. But the question now as we go into earnings season is if that trend will continue. We did have a stellar report from Alcoa yesterday beating expectations. What are your thoughts on some of the future earnings to come up?
Yes, the Alcoa surprise was really nice, and it's reflected this morning. But as far as the future earnings, we are slowing down, and we do expect continued slows in earnings until maybe the fourth quarter. However, the U.S. is still a shining light in the global economy, and with Europe in recession or near recession, the U.S. is a good place for assets to be placed until the global situation resolves itself. And
well, I agree with you that a slowdown was expected, but less than 1% growth year on year for S&P 500 companies in the first quarter is the latest stat that's out there. Do you think that that's a little bit extreme, and do you think that that will spook the markets if in fact it's the case?
It is a little bit extreme because so much cost cutting was done and revenues have returned to healthy levels. So I think the U.S. corporations have squeezed about as much as they can, out of the pie. And now we're in a consolidation phase, and the U.S. economy, the employment is kind of stable, not great, but it's not getting worse.
Yeah.
And employers are more willing to hire, at least they were until this last report on Friday.
Okay, so let's balance that, George, and bring you in on this as well. Sure. When we're looking at the U.S. fundamentals versus what we're seeing in Europe right now, which is going to play a more key role?
So, it depends on your time horizon. In the very near term, I think Europe, we've experienced in the past, has a huge influence on our markets. If things were to get worse there, you better believe that risk assets and risk appetite in the U.S. would drop and bond yields would go lower and so on. I think we should start to see through that. We've seen this movie 2 times before already, and we've seen the response function from the policymakers, both here in the Fed as well as in Europe. Eventually they get the joke and they provide more liquidity and make sure that there's this transition so that the markets don't completely fall apart.
But I think that's what the markets are worried about this time, that the QE3 might not be there.
And it might not be there right off the bat. And it might be some near-term disappointment come April. And you hear from Fed members, the more hawkish ones especially, that they don't want to see additional easing. But we think that there's going to be a slight pullback in the data. The markets are going to get scared because they've seen this happen 2 times already. We don't think it's going to be as egregious as it was in the last 2 years. And the U.S. fundamentals does have kind of that momentum behind it. It's the kind of self-reinforcing momentum, which should help U.S. companies do better over time. The key here, as Emily was saying, that there has been all this cost cutting. We really squeezed a lot out of U.S. corporates. The next phase has to be growth. The U.S. has to really have sustainable growth. The Fed is going to err on the side of caution and provide more liquidity just to get us over that hump. Especially as we look towards the elections, we have all this fiscal uncertainty. We think that QE is still a possibility come June.
Okay, Ross.